Hello investors, it's Ernie from Shark Investment Research, where I try to help you identify quality long-term dividend paying stocks for your consideration in your portfolio. Now there's a lot of reasons why folks like to have dividend paying stocks in their portfolio. Folks that believe in the fast lane mantra by M.J. DeMarco use these stocks to protect their wealth in their paycheck bucket. Some folks like to invest on a regular basis, say 10%, and they want to get something back in return for that investment. Whatever your reason for using dividend paying stocks, I want to help you save time and make more money by finding good quality dividend paying stocks for the long haul. Now, today we're diving in with the retail store industry. The Value Line Investment Survey studied 21 companies in total, but only 3 made my list as a quality stock to consider. Now, come on, let's dive in and take a look at these 3. We are starting out with Target Corporation, ticker TGT. Their dividend yield 1.7% on $164.57. Now that is effective 24 October 2020. We can see that they are not qualified by cash flow or earnings, and let's get that, there we go, sorry about that. They're still not qualified on cash flow or earnings per share, but they are a Div 0, so that means 17 years of increasing dividends per share, no flat years in there. Well, let's take a look at that graphically. Here we can see what that looks like, a pretty good upward trend on cash flow and earnings per share, with a little bit of zigzag going on, but really that's not too bad. More importantly, we see the dividend payout being a nice smooth upward slope. All right, in the year-to-year changes, the reasons why they're not qualified for dividend and earnings per share is pretty clear here, but every single one of those dividend bars is very clearly above the zero line. That's what we want to see. Okay, now we're comparing them to Walgreens Boots, ticker WBA. Wow, look at that, 5.1%. That is a very healthy dividend, and that's on $36.93. So folks are going to like that. There's a group of people out there that like to look for investments that are under $40 a share. So this clicks a number of concerns for those folks. Not qualified by cash flow or earnings per share, but they are a Div 0. That's the big thing we're looking at. Dividends, 17 years of increasing dividends per share. All right, let's look at them for the long-term trend. You can see they had a good upward slope going into 2014. Then it shot up even more. Took a little hit here in 2020. Gee, I wonder what's going on there. But they're going to recover nicely. They're in a good industry. And here we have their dividend stocks. Again, a nice smooth upward trajectory on that. Year to year, you can see what they look like. A couple of hits here for their cash flow and their earnings per share, which keeps them not qualified there, but those dividends per share are always above the zero line. All right, well, we're fortunate to have a third contender in this industry. Walmart, that should not be a surprise to anybody. WMT, but their yield is only 1.5% on $144.25. Again, all this data is effective 24 October 2020. Now, Walmart is qualified in the cash flow per share area as a CF1. So they had 17 years of increasing cash flow per share, with the exception of right here, 14 into 15. They are not qualified by earnings per share, and we can see that right here. But they are also a div 0, so 17 years of increasing dividends per share with no flat years. So they're actually qualified to be on our list of consideration for 2 reasons. All right, let's look at that graphically. Here we can see that's a pretty nice smooth upward trajectory on cash flow and earnings per share, and their dividend line is also nice smooth upward trajectory. On the year-to-year changes, we can see very clearly all above the 0 line except here where we talked about they had a little bit of hits on the cash flow and earnings, but still this is a nice looking company from the perspective of the dividend payout. All right, well, let's set them all one on top of the other because that's the best way to really take a look at all this stuff. In the solid blue line, we have Target. The dashed purple line is Walmart. And the red dots, Walgreens Boots. You can see that Target generally has outperformed the other 2 players. We have Walmart kind of coming in here around 2013, but really overall, Target has outperformed all 3 of the players for the long haul in cash flow per share. Earnings per share, a little bit more mixed story here. Walmart trading places and really close with Target. Then you've got Walgreens Boots comes on the scene and then falls down again. You know, all in all, though, these are pretty similar kind of performances here. All right, but we're talking about dividends. We want those dividends, so let's see what that looks like. Now, you would initially think that Target is outperforming here 1.7% on $164.57, but Walgreens Boots, their payout is 5.1%. It just happens to be on a small a small share price of $36.94. So that is actually the better performer for you at 5.1%. However, if you like the broader nature of Target or Walmart in what they are, then maybe you want to consider them, although at 1.5% and 1.7% on dividend payout, that's really not, I don't consider that to be shareholder friendly, although that's because I am a dividend looking person. There are a lot of other reasons to look at companies, and those I leave up to you. I am purely trying to help you find those companies that offer the best long-term quality dividend investments for consideration. If you are enjoying these dividend analysis discussions, go ahead and hit that thumbs up button. Subscribe to the channel, the little red button in the lower right-hand corner, and tell your friends so that they can be better informed investors as well. I also have some more videos coming up where I analyze companies from across the many spectrums of industries as identified by the Value Line Investment Survey. I look forward to seeing you all on our next discussion.